Something extraordinary just happened in the precious metals market, and if you're not paying attention, you're about to miss one of the most significant wealth transfers in modern history. Silver just shattered its all-time record, blasting past $66 an ounce. Gold is surging alongside it. But here's what nobody's telling you. This isn't just another rally. This is the beginning of something much bigger, something that's been building for decades, and the smart money has been positioning for this exact moment. Let me show you what's really happening behind the scenes. Right now, as I'm recording this, institutional investors are scrambling. Central banks are buying gold at the fastest pace we've seen in over half a century, not slowing down, not taking profits, accelerating their purchases. When was the last time you saw central banks panic buy anything? They don't move fast unless they know something the rest of us don't. The Chinese central bank has been accumulating gold for 18 consecutive months. The Polish central bank just announced they're doubling their gold reserves. India, Turkey, Singapore, they're all doing the same thing. These aren't emotional retail investors chasing a trend. These are the most sophisticated financial institutions on the planet, and they're moving billions of dollars into physical metal. Why? Because they see what's coming, and it's not pretty for anyone holding paper currency. Let me paint you a picture of what's actually driving this surge. It's not just one thing. It's a perfect storm of factors that are all converging at the same time. First, there's the geopolitical chaos. Eastern Europe is still a powder keg. The Middle East is more unstable than it's been in decades. Trade wars are escalating, and every time there's a new crisis, investors flee to safety. But here's the thing, they're not fleeing to bonds anymore. They're not even fleeing to the dollar like they used to. They're going straight to gold and silver. That's a massive shift. For decades, the US dollar was the ultimate safe haven. When things got scary, everyone bought dollars. But something fundamental has changed. Countries around the world are actively trying to reduce their dependence on the dollar. The BRICS nations, Brazil, Russia, India, China, South Africa, they're building alternative payment systems. They're settling trade in their own currencies. They're buying gold to back those currencies. This isn't conspiracy theory stuff. This is official policy. These countries represent nearly half the world's population and a huge chunk of global GDP, and they're systematically moving away from the dollar-dominated system that's existed since World War II. What does that mean for gold and silver? It means demand is about to explode in ways we've never seen before. But let's talk about supply, because that's where things get really interesting. Silver production has been essentially flat for years. We're not discovering major new deposits. The easy silver has already been mined. And here's the kicker. Silver isn't just a monetary metal anymore. It's absolutely critical for modern technology. Solar panels, electric vehicles, 5G infrastructure, medical devices, they all require silver. Industrial demand is consuming more silver than miners can produce. Think about that for a second. We're using more than we're making. Every single year. That's not sustainable. Eventually, something has to give, and when it does, the price is going to go parabolic. Gold has a similar dynamic, but for different reasons. Gold production peaked years ago. The major mining companies aren't finding enough new deposits to replace what they're pulling out of the ground. It takes 10 to 15 years to bring a new gold mine online, even if you find a good deposit today. The pipeline is running dry. Meanwhile, demand is surging. Not just from central banks, from everyday investors who are watching their purchasing power evaporate. Let me tell you a story that perfectly illustrates what's happening right now. Back in the early 70s, the United States faced a similar crisis. Inflation was spiraling out of control. The government had printed too much money to fund the Vietnam War and social programs. Foreign countries started demanding gold in exchange for their dollars, because they could see the dollar was being debased. President Nixon had no choice but to close the gold window in 1971. He ended the convertibility of dollars to gold. What happened next? Gold went from $35 an ounce to over $800 by 1980. That's a 23 times increase in less than a decade. Silver went from $1.50 to $50. People who owned physical metal saw their wealth multiply while everyone else watched their savings get destroyed by inflation. We're seeing the exact same pattern today. Massive government spending. Central banks printing money like there's no tomorrow. Inflation eating away at purchasing power, and smart investors moving into hard assets. But here's what makes this time different, and potentially much more explosive. In the 70s, it was mainly Western countries dealing with inflation. Today, it's global. Every major economy is running massive deficits. Every central bank is trapped in the same corner. They can't raise interest rates high enough to stop inflation without crashing their economies. So they're stuck. And the only way out is to keep printing money and hope for the best. That's not a strategy. That's a prayer. And the market knows it. That's why gold and silver are breaking out to new highs, even while interest rates are still elevated. Normally, higher rates are supposed to be bad for precious metals. But that relationship has broken down. The market is looking past current rates and seeing the inevitable outcome. More money printing, more inflation, more currency debasement. Now let me show you something that should terrify anyone who's not prepared. The paper market for gold and silver is massive. Futures contracts, ETFs, certificates. There are claims on hundreds of times more metal than actually exists in physical form. It's like a game of musical chairs where there are 100 people but only one chair. As long as everyone believes they can get their metal when they want it, the system works. But what happens when people start demanding physical delivery? We're already seeing cracks in the system. Premiums for physical silver coins and bars are running 10 to 20% above the spot price. That's not normal. That's a sign that physical metal is getting scarce. Dealers are struggling to keep inventory. Mints are running behind on orders. The disconnect between paper prices and physical availability is growing. This is exactly what happened in 2008 during the financial crisis. Paper prices crashed, but you couldn't buy physical metal at any price. Dealers were sold out. Premiums exploded. People who owned paper contracts found out the hard way that paper isn't the same as metal in your hand. Here's another piece of the puzzle that most people are missing. The commercial banks that dominate the futures market have been net short silver and gold for years. They've been betting on lower prices, selling contracts they don't have the metal to back. It's been a profitable trade for them because they could manipulate the market with their size. But something changed recently. Those same banks have been covering their short positions. They're getting out of their bets against precious metals. Why would they do that? Because they see what's coming. They have access to information and analysis that retail investors don't, and they're positioning for a major move higher. When the big banks flip from short to long, you need to pay attention. These are the same institutions that caused the 2008 financial crisis. They're not altruistic. They're not trying to help you. They're trying to make money. And right now, they're betting on much higher gold and silver prices. Let me give you some specific numbers that show just how extreme this situation has become. The gold to silver ratio, that's how many ounces of silver it takes to buy 1 ounce of gold, has been all over the map historically. Right now, even with silver at record highs, that ratio is still elevated compared to historical norms. If silver just returns to its historical relationship with gold, we're looking at significantly higher silver prices from here. But it's not just about the ratio. It's about the fundamentals. Silver inventories at the COMEX, that's the major futures exchange, have been declining for months. We're at multi-year lows. At the same time, industrial demand is at all-time highs. The math doesn't work. Something has to give. And when it does, the move is going to be violent. I want to talk about something that affects a lot of people watching this. If you have retirement savings sitting in traditional accounts, 401ks, IRAs, that kind of thing, you need to understand how vulnerable you are right now. Most retirement accounts are heavily weighted toward stocks and bonds. That's what financial advisors recommend. But here's the problem. Both stocks and bonds are priced in dollars. If the dollar loses purchasing power, your retirement savings lose purchasing power. It doesn't matter if your account balance goes up if that money buys less. Quick aside here. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description below. It covers how to get physical gold into your retirement account without triggering tax penalties. Worth checking out if that's relevant to your situation. The point is, diversification isn't just about owning different stocks. Real diversification means owning different types of assets. Assets that aren't all dependent on the same currency maintaining its value. Now let me show you what the technical picture is telling us, because this is where things get really interesting for traders and investors. Gold just broke through major resistance levels that have held for months. When you see a breakout like this on heavy volume with strong momentum, it's usually the beginning of a much larger move. The next resistance level is significantly higher. We're talking about a clear path to new all-time highs with very little standing in the way. Silver's chart is even more bullish. We just made a new all-time high. That's huge. It means every single person who ever bought silver is now in profit. There's no overhead resistance, no bag holders waiting to sell and get their money back. The path of least resistance is straight up. But here's what really matters. The breakout is happening on massive volume with broad participation. It's not just speculators. It's not just retail investors chasing momentum. It's institutional money, central banks, sovereign wealth funds. The smart money is piling in. That's the kind of setup that leads to sustained bull markets, not just short-term pops. Let me tell you another story that shows you how powerful these moves can be when they really get going. In 2010 and 2011, silver went from around $17 to nearly $50 in less than a year. That's a 3x move in 12 months. People who recognized what was happening early made life-changing money. But here's the thing. That move happened when the fundamentals were nowhere near as bullish as they are today. Back then, we didn't have central banks buying gold at record pace. We didn't have the BRICS nations actively building alternatives to the dollar. We didn't have the supply constraints we're seeing now. We didn't have the industrial demand from green energy and electric vehicles. The setup today is exponentially more bullish. And we're just at the beginning. Think about what's driving investment demand right now. People are scared. They're watching inflation destroy their purchasing power. They're seeing their grocery bills double. Their energy costs skyrocket. Their rent or mortgage payments consume more and more of their income. And they're looking for ways to protect themselves. Gold and silver are the oldest forms of money in human history. They've survived every empire, every currency, every financial crisis. When people lose faith in paper money, they always come back to precious metals. It's happened over and over again throughout history. And it's happening right now. But there's another factor that's going to accelerate this move: fear of missing out. As gold and silver continue to make new highs, more and more people are going to pile in. They're going to see their friends and neighbors making money. They're going to see headlines about record prices. And they're going to want in. That's when the real parabolic move happens. When the general public gets involved. When your barber and your dentist and your neighbor are talking about buying silver, that's when prices go vertical. We're not there yet. We're still in the early stages. The smart money is positioning now, before the crowd arrives. Let me give you some context on just how undervalued precious metals still are relative to other assets. The total value of all the gold ever mined is around $15 trillion. That sounds like a lot until you compare it to other markets. The global stock market is worth over $100 trillion. Global real estate is worth over $300 trillion. Global debt is approaching $300 trillion. Gold represents a tiny fraction of global wealth. If even a small percentage of money in those other markets shifts into gold and silver, the impact on prices would be enormous. We're talking about a market that's relatively small and illiquid, trying to absorb potentially trillions of dollars in new demand. The math is simple. Limited supply plus surging demand equals much higher prices. But here's what keeps me up at night, and this is something you need to understand if you're going to navigate what's coming. The financial system is more fragile than most people realize. We're running on borrowed time. Government debt levels are unsustainable. The banking system is still vulnerable despite all the regulations put in place after 2008. Derivatives markets are massive ticking time bombs, and central banks have already used up most of their ammunition. When the next crisis hits, and it will hit, the response is going to be more of the same. More money printing, more bailouts, more inflation, because that's the only tool they have left. And that's going to be rocket fuel for gold and silver. I want you to think about something. Every major currency in history has eventually failed. The Roman denarius, the Spanish real, the French franc, the German mark. They all collapsed because governments couldn't resist the temptation to print more money than their economies could support. The dollar has lost over 95% of its purchasing power since the Federal Reserve was created in 1913. That's not a conspiracy theory. That's official government data. A dollar today buys what a nickel bought back then. And the pace of debasement is accelerating. We've printed more money in the last few years than in the entire previous history of the country. The consequences of that are just starting to show up. Gold and silver are insurance against that debasement. They're stores of value that can't be printed into existence. They're real assets with intrinsic value. And right now, they're screaming that something is very wrong with the global financial system. Let me show you what the options market is telling us, because this is fascinating. Call option volume on gold and silver miners has been exploding. That's people betting on significantly higher prices. But it's not just retail speculators. Institutional investors are buying long-dated call options, positioning for a multi-year bull market. They're not looking for a quick trade. They're positioning for a fundamental shift in the market. The mining stocks themselves are starting to wake up. For years, they've lagged the metals. But that's changing. When mining stocks start to outperform the underlying metals, it's usually a sign that we're entering a new phase of the bull market, the phase where the really big money gets made. Here's why that matters. Mining stocks are leveraged plays on the metal prices. If gold goes up 20%, a well-run mining company's profits might double or triple. The stock price follows those profits, so you get amplified returns compared to just owning the physical metal. But you have to be selective. Not all mining companies are created equal. Some are well managed with low costs and growing production. Others are disasters waiting to happen. The difference in performance can be enormous. The point is, there are multiple ways to play this move. Physical metal for safety and insurance, mining stocks for leverage and growth potential, even royalty companies that provide financing to miners in exchange for a percentage of future production. Now let me address something that skeptics always bring up. They say gold and silver don't pay dividends or interest. They just sit there. Why would you own something that doesn't generate income? Here's the answer. Gold and silver are insurance, not investments. You don't buy fire insurance on your house expecting it to pay you dividends. You buy it to protect yourself against catastrophic loss. Same thing with precious metals. You own them to protect your wealth against currency debasement and financial system collapse. And right now, that insurance is appreciating in value while it protects you. That's the best of both worlds. But there's another way to think about it. If you own dollars in a bank account earning 2% interest, but inflation is running at 5 or 6%, you're losing purchasing power every year. You're getting paid to lose money. That's not a good deal. If you own gold or silver and the price goes up 15 or 20% while protecting you against inflation, you're way ahead, even without dividends or interest. The real question isn't why would you own precious metals. The real question is why would you not own them in an environment like this? Let me give you one more piece of evidence that shows just how serious this situation is. Physical gold is trading at significant premiums in Asia compared to Western markets. That's called backwardation, and it's extremely rare. It means people in Asia are willing to pay more for physical metal than the paper price in New York or London. They don't trust the paper markets. They want the real thing. When you see that kind of disconnect, it's a warning sign that the paper markets are losing credibility. And if those markets lose credibility, the whole pricing mechanism breaks down. We could see explosive moves as people rush to convert paper claims into physical metal. This is not theoretical. This is happening right now. The premiums are there. The backwardation is real. The warning signs are flashing red. So what does all this mean for you? It means we're at a critical juncture. The main event has begun. The forces that are going to drive gold and silver much higher are already in motion. Central banks are buying. Industrial demand is surging. Supply is constrained. The dollar is losing its status as the world's reserve currency. Inflation is eating away at purchasing power, and the financial system is more fragile than ever. This is not the time to be complacent. This is not the time to assume everything is going to be fine. The smart money is positioning now before the crowd figures out what's happening. You don't have to bet the farm. You don't have to go all in. But you need to have some exposure to precious metals, whether it's physical coins and bars, mining stocks, or precious metals in your retirement account. You need to be positioned for what's coming. Because when this really gets going, when the general public wakes up to what's happening, It's going to be too late to get in at reasonable prices. Premiums will explode. Dealers will be sold out. Mining stocks will be trading at nosebleed valuations. The opportunity will have passed. The time to act is now while most people are still asleep. While the mainstream media is still telling you everything is fine. While you can still buy physical metal at reasonable premiums and mining stocks at reasonable valuations. History is going to look back at this moment as the beginning of one of the greatest bull markets in precious metals ever. The question is, are you going to be positioned to benefit from it? Or are you going to be one of the people who wishes they had paid attention? The main event has begun. The question is, are you ready?